Good morning, everyone. I know people are still filtering in, but I'm going to get us started. We've got a busy agenda today. I'm pleased and proud to welcome you all to our 17th annual ULI Toronto PwC Annual Trends in Real Estate Program. My name is Emma West. I'm a partner at Bousfields, and I'm the chair of ULI Toronto. ULI Toronto PwC Annual Trends in Real Estate Program is one of our most anticipated milestones of the year and continues to welcome back our many loyal attendees, as well as first-time audience members. So welcome. As you will soon hear, this year's report is based on dozens of industry interviews and aims at a bit of a moving target. And so this sets up a fascinating conversation for us today. It was our hope to be in person with you again this year at the Carlu, but in the abundance of caution, we have kept it to a virtual event, and we're excited to see you in person next year. So, as a Toronto region-based organization, we acknowledge that the land we are meeting on virtually is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis peoples. We acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. We are all treaty people. Many of us have come here as settlers, immigrants, and newcomers in this generation or generations past. ULI Toronto stands in solidarity with Indigenous communities demanding action and accountability for the ongoing legacy of the residential school system. We'd also like to acknowledge and honor those who came here involuntarily, particularly descendants from those who were brought here through enslavement. To better understand the meaning of this acknowledgement, we recommend 4 programs and that are uploaded to YouTube, and we'll put the links for those in the chat right now. So a few housekeeping items before we get the program started. Everyone's going to be automatically muted. There's closed captioning available for the program, and you can find a button for that at the bottom of your screen. If you have any questions, please email us at toronto@uli.org. This is a recorded session. The recording is going to be sent to you after. And we would really love it if you take the conversation online. So please tag us at the handle ULI at ULI Toronto and at PwC_Canada with the hashtag ETRE2022. Now, an important part of our programming is our sponsors. Today's event and all other ULI programs would not be possible without their support, particularly our annual sponsors, but also our event sponsors. So a major thank you to all of you. I want to express our great appreciation and many thanks to today's event sponsors, which include PwC, BDP Quadrangle, Northcrest, and the Carpenters Union. Now, more than ever, ULI Toronto relies on the support of our sponsors who allow us to put on quality programming such as this and to drive our mission to shape the future of the built environment for transformative impact in communities worldwide. To all of you, we say a very big thank you. Now on to our agenda. You should all have received a digital copy of the report in your email already. If you didn't, don't worry, we're going to post the link for that in the chat. Our agenda for today starts off with a keynote presentation from Frank Magliocco, followed by a local panel spotlight on Toronto. And then at 9:30, we're going to close out the program with a closing conversation with Michael Cooper, President and Chief Responsible Officer at DREAM, and Leslie Wu, CEO of Civic Action. So for now, I'm going to pass it over to Derek Goring, Executive Vice President of Development at Northcrest Developments and Chair of ULI Toronto's Advisory Board, to introduce our keynote speaker. Derek, over to you.
Thank you, Emma, and a big thank you to you for your leadership of ULI Toronto through these most unprecedented times. It's really amazing to witness the ongoing growth and relevance of the Toronto District Council, and congratulations on recently becoming the largest district council in the ULI global network. Good morning, everyone. As introduced, my name is Derek Goring, and it's a great pleasure for Northcrest Developments to sponsor this year's annual Trans event alongside BDP Quadrangle and the Carpenters Union Local 27. On behalf of the ULI Advisory Board, I offer a warm welcome to everyone. To get our program started, it is my distinct pleasure to introduce our keynote speaker, Frank Magliocco, partner at PwC Canada. Before I introduce Frank, I would also like to thank the broader team at PwC Canada for their continued partnership in this event, including Chris Potter, Frank Asano, and Miriam Gurza, who will be today's moderator. Now on to Frank. Frank is the National Real Estate Leader for the Canadian Real Estate Practice at PwC Canada and the Managing Partner at PwC's Vaughan office. Frank also previously led PwC's GTA Private Companies Services Group. Frank has over 25 years of experience with both public and private companies. He is also a former treasurer and member of the managing committee of the ULI Toronto District Council. Frank's bio has been placed in the chat. Frank, over to you.
Great, thanks, Derek. And welcome everyone to the PwC ULI Emerging Trends in Real Estate that's now in its 43rd year. And I'm really excited to be here with you to share our results. Now, our PwC ETRE 2022 was developed from personal interviews of 930 senior executives, as well as 1,200 individuals in the real estate industry that took place during July and August 2021. Now, some of you may be wondering, where's Andy? As he's been presenting at our PwC ETRE results for what seems to be an eternity. Well, just like COVID caused many of you to pivot and embrace disruption in your business, we've pivoted too, and we've given Andy a break. And so hopefully I'll be able to fill in Andy's literally big shoes today. So why don't we get started? What a year 2021 has been. What many thought was a health crisis that would be over quickly has really turned out to be much longer than anyone ever expected. And after 18 months, where we witnessed a tidal wave of destruction caused by COVID and a subsequent tsunami of government support around the world, as one interviewee stated, the broad real estate sector is really finding its way through what is still a somewhat murky crystal ball. But notwithstanding the uncertainty and that initial stress to the real estate market, we found that people were generally much more optimistic and felt that the economy and real estate market have held up much better than expected. So what did we learn through this health crisis though? We learned that it's surprisingly resilient and ability to adapt quickly, especially when it came to the new ways of working in this virtual world. Now, we've talked about key forces of change impacting real estate in the past year's ETR reports. And what we found was that these trends were only accelerated during this year, resulting in certain asset classes taking off to new highs at the expense of others. And while new concerns and uncertainties emerged for what were historically some bedrock asset classes like office, it also led to interest in new sectors. Now, with these forces of change reshaping the Canadian market, it will be important for the industry to really think differently about these challenges while accelerating their own transformation and innovation. Now, many Canadian real estate companies actually fared quite well during the pandemic, and the interviewees were actually quite optimistic about the year ahead. And as you can see in this chart to the left, which clearly points to the optimism, and I think it's in part driven by the booming economy that we're witnessing. The housing market really took off. And for many of the developers that we spoke to during our interviews, they had record years. The industrial segment, it continued to strengthen, being really a top investment and development prospect for 2022. And the office sector, while it's really under a lot of pressure and uncertainty on how this virtual work experiment is going to impact the segment, it started to actually show some positive signs. And even retail properties didn't see the widespread failures that seemed possible last year, but some are still projecting weaker outcomes in this sector in the future. So the top common themes that we heard louder than ever really revolved around the changing world of work and how this is going to impact the housing and office sector. Will space be given up? How much? Will there be a rush to the 18-hour cities, given the continued affordability issue and the now accepted work from anywhere? These were all key questions owners and tenants were asking themselves as we interviewed them. The second loud theme that we heard was around ESG. ESG is coming fast and furious with real estate in its crosshairs. Now, European real estate companies are significantly ahead on this issue compared to our North American real estate companies, but the sentiment in ESG is now table stakes, and real estate companies need to up their game in this area, if not simply to preserve value in their organizations. Finally, costs and competitions. Now, if you recall, a number of years ago, we talked about that wall of capital. Well, for many, it feels there was an actual tsunami of capital, all directed towards real estate, which is really driving competition in all asset classes. And the disruption to the supply chain, the significant pressure on labor availability, and the increased competition has just driven costs through the proverbial roof. And under all of this runs the persistent and ever increasing affordability issue. Now, we've seen some significant shifts in the world of work that have had a major impact across the real estate market. And one thing's for sure, respondents to our PwC ETRE report couldn't agree where it was going to land. Some thinking it will go back to normal, while others believe this significant shift is permanent. But if I could summarize a common view that we actually heard, is that the new normal is flexibility in approach. There's definitely a push-pull happening as some business leaders really want to get their employees back in the office, while staff are still a bit hesitant to return. And with the significant war for talent, this is going to be really a delicate balancing act for many. That's why you may have heard some employers like PwC in the US that now have said staff can choose virtually as a permanent option and work remotely from anywhere. And while many interviewees have indicated that this will have an impact on developing the culture of their organizations, others have said better to have employees than none at all. Now, PwC recently published a workforce report, and the key findings were that COVID clearly had accelerated the digitization and digital skills for many. Some say as much as 10 years, with 40% of the workers saying they improved their digital skills and feel it's their personal responsibility to do so. And almost half believe their traditional employment won't be around in the future. And what was really interesting was that 83% felt confident that they could adapt to new technologies that were impacting their roles. And in this employee survey, what was interesting was that a low percentage of employees that want to go back to the office on a full-time basis, with 72% who said they can work remotely would prefer in the future a mixture of in-person and remote working. We've had a new survey launching in November, and we've seen actually a slight shift in preference towards more fully remote working. So employees clearly want more digital skills because they see that their roles are changing significantly due to new technology and automation. And employees want more flexibility. Another thing to think about comes from Microsoft's 2021 Work Trend Index report, where over 40% of the global workforce is considering leaving their employer this year. So I think a thoughtful approach to the hybrid work is going to be critical for attracting and retaining diverse talent. Now, while Canada has still some of the tightest office markets in North America, I think the future of this asset class is going to really depend on what happens to this changing world of work experiment. What is clear, though, for property owners is that they will need to address the purpose of physical workspace will serve and adapt. And those real estate organizations who keep these preferences in mind and really offer flexible solution to their tenants that enable them to adapt to their employee preferences to retain their talent will be better positioned to compete in this new office environment. Now, the changing world of work has also had a major impact across other asset classes. notably the housing market. Remote working has really opened up opportunities for some Canadians to move out of the major city downtown centers, where their offices have typically been located, to more affordable locations. And this has really led to rapid growth in the housing markets of suburban areas and secondary cities. And as you can see in this chart, the growth rate in population in the smaller cities has really outpaced those of the major Canadian, we'll call them gateway cities. And this trend has been prominent in the US for a number of years, and it continues to be present in the US. Now, the availability of qualified labor was one of the top economic and financial issues identified by our survey respondents this year. And according to Stats Canada, job vacancies in the construction sector rose by 33% in the first quarter of 2021, with 34% of businesses surveyed citing recruiting and retaining skilled employees is really an obstacle for their organization. But this is not something that we are solely seeing in real estate. This war for talent is impacting all businesses. And unemployment rates are at their lowest level since before the pandemic, and things start to return. And as they return to normal, the job changing rate has also returned to pre-pandemic levels. So really, it's not that surprising to hear that labor availability is a top concern. This war for talent has been brewing for some time and will only contribute to cost pressures that are already being experienced by the sector. So as we kind of move into the different property types, I wanted to share this quote with you from one of our interviewees. I really kind of like this sentiment behind it, which is, I think, let's just be cautious out there. So 5 years ago, in our ETRE report, we coined the term the rise of the permanent renter, given the affordability issues that were making headlines. And today, we actually see that manifesting itself into new opportunities. And something new this year in our interviewees was the discussion of single-family rental. Now, in the US, they've been talking about this and executing on this strategy for some time. But this was the first time where it was actually discussed here north of the border. And that is why single-family rental housing was actually among one of the top subsectors for investment and development prospects this year. However, interviewees had diverging views on this issue and whether this trend from the US is really going to take off in Canada. You know, one interviewee said that single-family rental homes are difficult to manage and noted that land costs in Canada tend to be too high to make the numbers work, not to mention the harsh winters. But if good operators can make this work, it has the potential to assist with affordability and provide access to an underserved segment in the rental market. Now, the industrial real estate markets continue to experience really strong demand, with warehousing and fulfillment ranking as the top investment and development prospect once again this year. The rapid growth of e-commerce on the back of retail is really driving this market to new highs. There's also significant crossover and blurring of lines between this asset class and the retail asset market, specifically as an opportunity to facilitate last mile delivery of goods. We also heard this year a rising interest in vertical or the multi-level industrial spaces. And while vertical spaces can be quite expensive and they involve, considerable complexities, I think the market should expect to see more of this as the demand for and cost for industrial real estate continues to rise. Now, while the pre-pandemic woes of the retail segment is very well known, the COVID lockdowns were really a harsh blow to this segment. And however, the ongoing economic recovery that we're seeing, and I believe the pent-up demand and high household savings is actually boding quite well for consumer spending and retail activity. Now, in PwC's recent study on Canadian consumer shopping trends, it found that many consumer behaviors that became entrenched during the lockdowns, notably the shift to buying goods via digital channels and increased shopping at discount retailers, are really persisting. So as retail landlords look to adapt in response of these changes, the focus is shifting towards repurposing spaces to stay relevant for consumers and finding ways that they can bring value to retailers and their customers, such as sharing data and offering more diverse experiences, shared and community services, and a better retail mix to tenants and their customers. Also, densification of parking lots into multifamily rentals and condos are opportunities that they are also considering to create value in their portfolio and for their tenants with more foot traffic. They're also considering opportunities to repurpose space, as mentioned earlier about this last mile delivery. All of this to say is that the owners of retail need to reimagine their retail assets to stay relevant and, more importantly, to really just preserve value. So to round off the other property classes for office, both suburban and medical office showed improvements in 2022 based on the expected market investment sentiment when this was compared to the last 2 years. However, for central city office, the 2022 market investment sentiment actually decreased. So it was clear that interviewees had mixed views on the impact remote working will have. Regardless, I think a close eye on this asset class is going to be needed. For multifamily, it continues to be really strong asset class. There's lots of demand and a ton of opportunities. And then in terms of alternatives, we actually heard a lot of interest in the life science assets. And maybe it's not surprising just given the spotlight that health has had for the last 18 months. And as well, there was actually quite a lot of talk and people were quite bullish on storage facilities as well. Here's a sample of quotes that we heard from our interviewees across Canada, where affordability, ESG, technology, and cyber were really top concerns. And if you take a look at the US, and I borrowed this slide from our US counterparts, you can see that their key issues are really not that different than what we're hearing north of the border. Now, we've been speaking about this affordability topic in our ETRE reports for a number of years. So I guess it begs the question, is this really an emerging trend? You know, the pandemic accelerated many existing trends and has shone an even brighter light on this topic. Social divide, what seems to be an uncontrollable escalating home price, has made this issue even bigger. So affordability remains an issue even in cities where it previously wasn't. And to quote Peter Gilgan, the owner of Mattamy Homes, in a recent BNN interview, he said, developers and government have to wage war on affordability. Case in point, ownership costs as a percentage of household income reached 56.8% for single detached homes in January 2021, according to RBC Economics. Also, the Ontario Home Builders Association recently issued a report that determined that in Ontario, over the next 10 years alone, 910,000 homes will be needed for new families. And the report stated that failure to do so is going to make it impossible for Ontario to attract and retain the talent it needs to compete in the global economy. The increasing levels of immigration being promoted by the government is only going to add to this issue and put pressure, more pressure on affordability. And, you know, will that growing interest in single family rental that we talked about help address the issue? Or will it just compound this issue of affordability? All important questions. So what's the solution to this issue? I think supply exists out there. We just need to frack it out. That's what one of the interviewees said. So first and foremost, we definitely need more supply. And we need all three levels of government are needed to work together alongside the developers to really make this happen. Governments need to fight back NIMBYism first, as that often blocks needed supply. But overall, I would say we would need, and what we heard is that innovation is needed to help drive new supply, whether it's allowing innovative zoning and faster approvals, or permitting multiple suites in single family homes. We also need innovation in driving more ownership accessibility, such as rent to own or down payment assistance. There needs to be more innovation around construction tech to get those costs down, specifically around labor. Clearly, there's a need for innovation around government initiatives that can help drive more purpose-built rentals through incentives and other programs. And we also heard that we need new initiatives and programs that can attract and develop more skilled trade labor in this sector to help build the housing that we need. To summarize, we need more innovation and cooperation to really address this issue. Now, it was clear from our interviews that the prop tech industry has reached a level of acceptance. And the use of the technology to better understand and manage properties has really accelerated sharply. And despite, though, this higher acceptance, the prop tech industry still holds significant areas for future growth, as evidenced by the flow of funds in this sector. Now, prop tech can do a lot more than just efficiently operate and manage a property. It can also help tenants efficiently use their leased space as a way the people continue to work evolves. However, a new generation of data analytics seems especially promising, allowing companies to use artificial intelligence and predictive analytics to proactively identify opportunities and uncover ones that previously weren't seen. So the most proactive companies are seeking out and adopting the most recent prop tech innovations and really leading the industry by change. But with all this technology, one thing is for certain is the increasing cyber risk that follows. And cybersecurity was a clear and growing concern among many of the interviewees this year, ranking it as one of the top industry disruptors. So real estate companies will need to continue to manage their cyber risks. And failure to do so can result in significant consequences that really undermine stakeholder confidence at a time when trust in your organization has never been more important. Now, environment, social, and governance, or ESG matters, have been increasingly important issue for the industry. And it's not just the E, but it's the S and the G that are getting more and more attention. But like most trends, there's actually differentiating views on how to best navigate these issues. What's clear is for institutional investors, ESG are table stakes and are becoming a key criteria for all investment decisions. However, on the private side, we heard a lot less urgency on this front, where there needs to be a clear return really to justify the additional costs. And we saw this divergence reflected in our responses to our online survey this summer. So while ESG matters are definitely on the agenda of many interviewees, the participants attached only a moderate level of importance to key issues like climate change, diversity and inclusion, and environmental sustainability requirements. But climate risk can't be ignored, and ESG performance is going to be a rising factor in the long-term value creation and preservation for the real estate industry, whether it's by attracting premium rents and better leasing, or improving saleability and asset pricing, or just simply accessing lower cost financing. ESG can't be ignored going forward, and really to do so will be at your own peril. Now, with this wall of capital for real estate that we've seen both here locally, but also globally, what's next for all of these different property types? We're seeing a lot of competition for properties in all asset classes, but some are getting much more attention than others. And so what I thought I'd do is I'd share some interviewee quotes that summarize the consensus feeling of the different property types before we get into our best bets. So this is what we heard for industrial and rental. This is what we heard for office. And this is what we heard for retail. If you take a look at the top prospects that came out on our ETR interviews this year and look at both Canada and the US, you could see that they're actually relatively consistent with industrial, housing, and alternatives at the top. And now if we go to what is our kind of tradition of looking ahead in terms of top markets to watch and best bets, these are the top markets and best bets for 2022 based on the consensus view of our interviewees, with not much change from the prior year, with Vancouver and Toronto at the top for markets to watch, and with warehousing and fulfillment and rental housing at the top for best bets. And to come back to my favorite quote I mentioned earlier, there is money that can be made and lost in every asset class. So while you do need to be careful, these new forces of change are really creating new opportunities for the industry. With that, I just want to say thank you. And I hope you enjoy the rest of the day. And I am now going to turn it over to Mike York, who is the president of the Carpenters District Council of Ontario.
Frank, thank you very much. You know, on behalf of the Management Committee, I want to thank you for presenting Emerging Trends Report virtually this year. And as Emma had noted earlier, we look forward to a return to in-person next year. Now, our large audience here today is really a testament to the high level of interest in your report, written in cooperation with your colleagues at PwC Canada, and really also a testament to the extensive research that you have conducted. So well done on that. Now, many truly fascinating insights you mentioned today. I love the idea of the ESG and the Peter Gilligan quote. That was important. Affordability on housing and addressing the housing crisis. Looking forward to challenging the changing world of work, but I got the central theme is certainly one of optimism amid challenges and opportunities. Now it's my pleasure to introduce Miriam Gurza, partner, PwC Canada, who's our moderator for our Toronto Response Panel, as we further explore the emerging trends in real estate for 2022. Miriam is Managing Director and PwC Canada's National Real Estate Consulting Leader and Vice President of PricewaterhouseCoopers Real Estate Inc. She is currently spearheading the Data Analytics Initiative with a focus on the real estate industry. Miriam brings a unique perspective and experience in data analytics, financial investment, and real estate systems. We couldn't think of anyone better to lead this conversation. Miriam, I'll pass it over to you to introduce our panelists. Miriam.
Thanks, Mike, and good morning, everyone. Today, I have the pleasure of being joined by our panelists, Ash Lawrence, who's the Managing Director and Regional Head of the Canadian Real Estate Business for Brookfield's Real Estate Group, Jamie McKenna, who's the Managing Director and Group Head of Real Estate for Fengate Asset Management, Colin Johnston, President, Research, Valuation and Advisory Canada for Altus Group, and Andrew Duncan, Chief Investment Officer for RioCan REIT. So welcome and thank you for joining us today. Let's dive right in. We've heard a lot about accelerated disruption in the past year and a half. This year, our survey responses indicate a lot of optimism. We've heard that from Frank's presentation. Housing market booming, industrial markets on fire, office and retail are both showing positive signs despite what we had originally thought would happen. Can each of you explain one thing you're optimistic about for next year and what are your best bets? And we'll start with Jamie and then go to Andrew, then Ash, and then Colin.
Thanks, Miriam. So the one area that there's a couple areas that I'm optimistic about, and I think Frank's presentation was excellent at highlighting those. From a rental perspective, it's been great to see how quickly that product, that asset class has recovered during COVID. And I know when we first came into this situation in 2020, we weren't quite sure how to underwrite growth rates and recovery of rents. And I think what we've seen is it's been better than we anticipated. And it goes beyond just your traditional rental product. Like Frank talked about moderate rental housing, but going into even some of the alternatives, the affordable component, there's a great trend to developers wanting to be able to incorporate that into our projects. And there seems to be a great deal of support, as well as even things like seniors housing. We have a relatively large seniors housing portfolio, and the recovery is coming pretty quickly in that area too, as health measures have come in and been able to protect the residents.
Thanks, Jamie. Andrew?
Thanks, Miriam. Thanks, Jamie. First of all, thanks to ULI and PwC for putting on this great event. It's one I look forward to every year, so I'm honored to participate in the panel. In terms of what I'm optimistic about, I think when I thought about the question, it was mostly seeing the impacts of the increased immigration that's happening this year, or return to pre-pandemic levels from an immigration standpoint, and the fact that the targets for next year are even a little bit greater. and seeing the impact of what that's going to do to the real estate market as a whole. In terms of best bets, it's a little bit self-serving, but you know, I'm a big fan of our opportunities in grocery-anchored retail going forward. It's an asset class that's really weathered a storm through the pandemic, has done extremely well. And to Jamie's point, you know, we're heavily invested in residential rental. We're seeing a ton of recovery and a ton of return to the growth rates we saw in rents pre-pandemic. So really excited about those two asset classes.
It's on to me here, Miriam. Yeah, so I'll take a step back maybe and say over the last course of 2020, where I am very optimistic is that, and we haven't solved it, but the progress we've made on the health front, which caused all this mayhem over the last 18 months, we've really taken a big turn around vaccinations. We're now hearing about the timeframes for children under 12 to be vaccinated. We're hearing about therapies around COVID, if you do actually still catch COVID, that are now showing some progress. And I think that is a big, big move to get us to where we are today, which is people and business really, quite frankly, roaring and moving forward to get sort of past the health issues. And it does feel like, although it's still there, we are sort of starting to move past it and manage it in a way. We're not eradicating it, but manage it in a way where the economy can do what it's doing now, which is really, really quite strong. I think it's hard to be negative about anything if you're in real estate in Canada. And so you can pick almost any asset class and be positive. But I think the overall picture is allowing that positivity in the real estate sector to continue.
Colin?
Yeah, thanks, Miriam. And again, it's lovely to be here. I guess I'm very optimistic, most optimistic about the return of investment capital. We know what happened in Q2 last year. That things pretty much ground to a halt. But if we take a look at the first 6 months of this year, we're up about 56% over the previous year. Probably not surprising, but I think more significantly, investment activity is up 30% over the first 6 months of 2019. So that dry powder that was on the sidelines has come back with a vengeance, and it's being deployed in virtually all asset classes, which is good to see. We talked about grocery anchored strips, a lot of money flowing to that, and in multi-res as well. Even in office, which we'll talk a little bit about later. I would say that it's hard not to be, if we're talking about best bets, continue to be bullish about industrial. You saw the MSCI mid-year returns. Industrial had a plus 20% overall return, which is pretty phenomenal. And I think when you've got about 2% vacancy nationally, and you see rents climbing and cap rates going down, you just can't help feel that there's a continued run for that asset class.
Yeah, thanks, Colin. I think in general, real estate professionals tend to be optimistic. It's the nature of our business. But thanks for everyone's insight on that. And just building on that, a very hot topic these days is the world of work. We know from research and what we heard this morning on our survey results that many employees are still hesitant about returning to the office and are looking for hybrid solutions. Office space have needed to evolve over the past 18 months. So with this trend in mind, where do you think GTA office is headed in terms of demand, as well as repurposing or reimagining the way we use space? And we'll start with Ash on this and then go to Colin.
Yeah, so when we think about return to the office, I kind of think about two things. So first of all, I think we've moved on from return to the office being related to health concerns for the most part. I think it's more apparent in the US where you see, 150,000 people going to a college football game, but they won't go back to the office. So I think we've moved on from it being a health concern. And I think where we are now is that this is really an employee retention. The job market is so strong. The great resignation where people are switching jobs or leaving jobs and doing their own thing for various reasons. I think that is really what is going to drive how and when people return to office. As it relates to the office itself, I think people are still figuring it out. We, in our portfolio, and we have some new buildings where we're turning over space, we really haven't seen a lot of drastic redesign. We've seen a lot of thinking about it, but people really haven't figured it out because they haven't figured out how and when and who is going to be back in the office and for what purpose. I think we're getting there, but I think to a large degree, a lot of companies haven't figured out how. And I think some of the delays you're seeing in return to office are actually more about them still trying to figure it out. And it's not easy to switch up an office configuration if you're a bank, as an example.
Right.
It's a lot of money and a lot of time. I think some of those delays are less about health and more about we still need time to figure out how we're going to do this.
Yeah, I just echo a lot of Ash's comments. I will say one thing, Miriam. Consultants are going to make a lot of money, those space consultants, over the next little bit, because I really think this, when it comes to utilization, configuration, and demand, it's definitely going to take some time to play out. And I think, I think not everybody, you don't want to lead necessarily. You sort of want to lead, but you don't want to make missteps on this. And therefore, you're going to see people taking a little bit more time to figure this out and talking to their employees a lot. But you asked questions about, GTA office. And I would just point out that in Canada, we had some of the healthiest office markets going into in North America, going into a pre-pandemic. Very low vacancy. We had rising rents, et cetera, in a lot of markets. And so we were very healthy. We were not overbuilt. And even the 10 million square feet that's under construction in Toronto right now, 65% of that is already spoken for. So I think as a valuer, 10% sort of a normalized vacancy level. And so I don't see us, really having anything with regards to an office crisis in the future. What we have seen is naturally sublease availability did rise. But we saw rental rates not really eroding much. We saw TIs and landlord packages increasing, but for the most part, we have a lot of institutional ownership of our office buildings in all the major markets. And these owners can ride out the storm pretty well. And I think as long as you've got term and you've got covenant, values will continue to hold. And I'll just say my last point would be, I think a lot of people are continuing to bet on office. I'm encouraged by the investment activity I'm seeing in be it Toronto or Vancouver or Montreal, where office buildings are trading and are on the market, and they're not at discounted prices for good office. So I believe that people still believe that there's going to be a need for office in the future. And that's why people are stepping up with investment dollars. And I think the question is, for the older B and C buildings, I definitely think we're going to see, there's a different story with regards to those. But I think office is going to be here for the future. It's just going to look a bit different.
Thanks, Colin. And I've noted down about this thing being good for consultants. But as a follow-up to that, what kinds of innovations are you seeing to help the office real estate landscape bounce back? And I'll have Jamie respond to that in a suburban office environment, and then Ash on the core market.
Yeah, absolutely. I mean, the suburban market has a unique positioned opportunity to capitalize on, whether it's return to office or flex office, that sort of thing, in the sense that our leasing activity picked up substantially in 2021, and that's because of satellite offices. And, that sort of gives that hybrid solution to what Ash was referring to, which is, making people's lives easier to get to the office. Because if we're going to get them out of their homes and into the office again, it's got to be a little bit less disruptive than we were used to pre-pandemic. So what we've done, and I think it's sort of half the landlord and half the business themselves need to work together and understand, how do you make people's lives easier in the office? So, a great example, and it seems like a small thing, but has had a big impact, is food delivery services. Suburban office isn't naturally close to or has easy access to food without having to leave and maybe drive somewhere. And so we've introduced the concept of like a DoorDash, which, companies can sign up to it, and then the entire floor can kind of program what they want delivered, and it's free. And it's just one example, but it actually is just a theme in the need to program the office experience for employees to come back. And creating that ease of access as well. So that's, like I said, I'm quite bullish on the suburban office market. If you can combine that convenience with the availability of satellite office space to reduce commute times for people.
Ash?
Yeah, as it relates to sort of the more urban setting, I think I would echo still a lot of what Jamie said for the suburban settings. I think solving some of those issues, whether or not you're in the core and I'm close to amenities or not, I think the use of the office and what you're doing there is going to change, and things like food delivery services, etc., will adapt to that. But I would say there's really two things I see in the urban market, which is first, and this started early on, is sort of health innovations around the office space, around people mixing, around HVAC, around new systems to run elevators so you don't cram 20 people into one elevator.
Right.
I think those are all things that came about sort of last year, and quite frankly are in place and still being worked on, but haven't really been tested because we haven't seen the return to office like we saw. I think the other big innovation you're seeing is what I was referring to earlier, which is actually the physical space and how to design incredibly flexible spaces. This is not something that's new. I think with a lot of trends, COVID just sort of accelerated this, and you were seeing this already in prior years. I think the urgency of it and perhaps the level of flexibility has taken on sort of a more urgent and greater role. And I think the other thing you're going to see is that design of the office. If you have employees that are only in the office 2 days or 1 day a week, that 8-hour day or 9-hour day or whatever it is becomes much more vitally important to engaging them with the company, making sure what they're there to do, which in most cases is going to be some form of collaboration, that you have set up the environment where that is extremely successful. And 3, that is really your opportunity for culture. And so all of a sudden your office environment becomes way more important. If I work for company A in my office at home, I have the exact same environment as if I work for company B in my office at home. But that 2 or 3 days a week where I'm in the office, that's where you're going to set the culture. So that environment, what you're doing there and how you set up that space just becomes way more important.
Yeah, Ash, there's been so much conversation around that whole element of how do you continue to develop the culture that can't really be developed when you're sitting at home like we are today. And you're right about that importance of creating that environment that's relevant in the office, that really develops that and has employees feeling more of belonging and really wanting that career within that environment as opposed to a job, right?
Right.
So just looking at retail now, there's been a lot of focus over the past 18 months on the, retail, the impact of the lockdown, temporary versus permanent shifts to increased online shopping. I mean, there's been huge adoption of online shopping because we had no choice really. And that's been at the cost of bricks and mortar. But looking forward, we heard that that's not all doom and gloom. We saw that in Frank's presentation this morning. So, give us your thoughts on where you believe there have been temporary versus structural shifts in this sector. And has there been a blurring of lines between retail and industrial? Is there's going to be this hybrid term with this asset class? And I'll have Andrew respond to that first, and then followed by Colin.
The RioCan guy can answer the retail question. Okay, so
yeah, that makes sense.
I think to your question, Miriam, a couple of thoughts. I think the pandemic, the way we view how the pandemic's influenced retail, is an acceleration. It's been a disruption to a certain point, but what has happened during the pandemic to retail was happening pre-pandemic, and the online shopping and e-commerce was present before that. So the pandemic's accelerated it. We were responding to that situation beforehand, and we continue to do so. I think, your term hybrid, in terms of retail industrial, I think with the advent of e-commerce, and what we're seeing is a large component of that e-commerce being buy online and pick up in store. A lot of our retail locations are turning into pseudo-industrial locations without changing at all. So we're seeing, if you look at our second quarter results in terms of where we are, and maybe the way to step back and look at this is if our organization is a bellwether for retail through the pandemic, and when the pandemic started, a Our rent collection went down. We lowered our valuations responsibly. And as we've gone through the pandemic, you know, as of our quarterly report, we were at 95% rent collection and 96% occupied. So we're kind of back to where we were and moving definitely back to where we were for rent collection and occupancy. And I think we've seen an acceleration in what we're already doing in terms of curating tenants that were appropriate for today's market and responding to what the needs of our tenants and our customers are. So the last thing I'd say about retail is I think the other thing that the pandemic's done is created further bifurcation in retail as a sub in terms of sub asset classes, right? Like grocery anchored strips versus unenclosed versus enclosed versus, you know, mixed use urban. They're all very different asset classes and are being underwritten and valued very differently. We've got all of that. We're responding to each of those asset classes differently. But again, like I said at the beginning, I'm quite optimistic about the future of retail going forward, given immigration and the demand and the pent-up savings in the Canadian market.
Yeah, just to add to Andrew's comments, I would say that the retail store as a point of delivery and fulfillment is definitely here to stay. I think, you know, e-commerce grew 75% during the pandemic. It went from, you know, 7 or 8% of total retail sales to, depending on who you believe, anywhere from 12 to 15. But that spike was a spike. I definitely think it is here to stay, but we're not going to see the same growth at the same levels, Miriam. I just don't think that's going to happen. And if we take a look at the first 7 months of sales this year, it is positive for retail. We're up about almost 16% year over year. And what's nice to see is clothing's bounced back in a significant way, clothing and fashion, which was naturally one of the things most hit and one of the classes most associated with enclosed shopping centers. So to see that rebound has been encouraging. Do I think we're going to see, you talked about the blurring of lines. I think I tracked 24 malls, ghost malls in the US, and over 8 million square feet that turned into pure distribution centers. I'm not sure if we're going to see that in Canada. We don't have the same retail square footage per capita. We certainly have some malls that are weaker. And as Andrew said, there's this bifurcation that's been accelerated. The strong have gotten stronger and the weak have gotten weaker. And I think we'll just see that acceleration towards redevelopment or repurposing for some of those assets. But I think, you know, if I was to raise some concerns with retail, it would be the restaurant industry. There's 129,000 open jobs there. More than 10,000 restaurants have closed their doors, and the question is how many will reopen. And food is one of the things that we like we like going out. And if you looked at enclosed shopping centers, food halls and the restaurant experience and experiential retail were part of the sort of new anchors. And I can think of a lot of centers that really invested in that. So I think what's happened to the restaurant industry has been very difficult. And I think they would say unfair with regards to their capacity restrictions, just like fitness. So for myself, I think it's going to be fitness and restaurants. I think it's going to be interesting to see how those play out as sectors going forward. And we won't know until capacity restrictions are fully lifted. And I think, you know, hopefully that's going to come sooner rather than later, certainly in Ontario.
Yeah, Colin, the whole impact on restaurants, I'm sure that everyone on this call has tried to make reservations lately to a restaurant. And unless you make them 2 or 3 weeks in advance, you're not going to get that reservation because there's just so few. There's few spaces within the restaurants, and you can see how that's impacting their revenues. So just turning to residential, which, you know, was a very significant portion of respondents talking about the residential sector affordability. There's a lot of repositioning of retail and other assets to meet housing demands. We're seeing trends in population shifts out of the cities to secondary cities. You know, there's headlines in the paper around exodus to Atlantic provinces. We saw the increase in migration to secondary cities like Ottawa, Halifax. And then ultimately, as immigration starts to flow from international markets, which we're going to be seeing very shortly, there's going to be further pressure on housing. So then in this context, we see a resurgence of purpose-built rentals. And so what do you see are the opportunities and constraints in purpose-built rental versus condos. And we'll start with Andrew on this and then go to Jamie and then Ash.
Thanks, Miriam. I think when I read your question, we talked about it. I don't know if I'd call it a resurgence. At the end of the day, you know, as an example, throughout the pandemic, we had 6 residential rental buildings under construction, all purpose built. And due to the, you know, the work we had to do with the provincial and federal governments to keep those construction sites open and all the testing and stuff like that, but we kept building them. And that's resulted in us going through lease up on a couple of these projects, you know, early in the pandemic and continues. And we've seen a lot of momentum in terms of absorption and growth. So I would say it's an asset class that got quiet from a rental growth standpoint, but a lot of people who were in it remained convicted that they should be and proceeded with it. So the opportunities going forward, I think purpose-built rental is not a cheap asset class to build. You need to have a very deep balance sheet to do it. I think there's room in the market for both condo and rental, and there's a requirement for both because you need to have more than just institutions building housing. So, you know, we're focused on both those asset classes, but I think, you know, given the demand from institutions to own multi-purpose rental in their portfolios and the limited expertise of how to build them and the willingness to take the risk in building them, I think it's a huge opportunity for those who want to do it and continue to do it.
Do you see any constraints?
I think the constraints are, as I said before, costs. I think escalation in cost is tough. I think we're going to talk a little bit about the affordability crisis in one of your next questions. And I think some of the mandates around what purpose-built rental costs as opposed to condo, some of the government regulations make it more challenging. And finally, the constraint is also the opportunity. You've really got to have a lot of conviction to build multi-purpose rental because you don't know what you're going to get from an income standpoint until you build it.
Right. Okay, Jamie?
I would echo a lot of what Andrew said. I mean, the obvious opportunity, those are 2 hard words to say back to back, is immigration. You know, immigration taps have been shut off for almost 2 years now, and there's over a 10% anticipated increase to over 400,000. 400,000 people come in, 67% of them need to rent. So the demand is there. The desire for people to rent for a longer period of time because of housing affordability, like all the fundamentals were the same they were before pandemic exist today. And that's why our firm, for example, continued to push forward. But we struggle with the costing of the pricing. Land prices specifically in the GTA make it very difficult to build purpose-built rental in a location that also makes it convenient to get across the city. So trying to find a transit-oriented site and justify rental numbers is very, very difficult. And it's counterintuitive because the people that need transit are likely also the people that need the more affordable housing. So there's a lot of work that needs to be done to be able to get, you know, the developer financials to tie into what the needs are for society. But to your point, to Andrew's point as well, I mean, one of the things we look at now is wider or larger sites that offer us more flexibility so that can you do both condo and rental on the same site, leverage the more efficient economics of a condo to make and then result in purpose-built rental longer term so you have that longer term yielding asset to hold.
Ash?
I guess I would echo basically everything that was said. It's hard not to see.
You need to be controversial.
Yeah, so I will add something, but it's hard to not argue with the opportunity on the revenue and demand side. And I think everyone is fully aware of the cost pressures that are occurring. The one thing I would say, well, we talk about sort of, we use the term resurgence of purpose-built rental. What I will say is that pipeline is incredibly small relative to the existing stock and relative to what is required to actually house our continuing increased population. And I think when you look at that and what that supply really needs to be, and you tag that with the cost issue, which a lot of that is labor issue, I think our biggest constraint is we need more supply, but we don't have the resources to actually build it right now. I think even if we could find a way to increase the sort of construction levels and number of units we're building, the cost increases will just get worse because there are certain sub-trades that just couldn't handle. We need to double the amount of purpose-built rental we're building. If that were to happen, we would have a very big problem on the labor side, and the cost structures would go crazy. So I think the cost issue, if we actually want to solve some of our housing problem and continue to build sort of what is a great investment vehicle in purpose-built rentals, we really do have to address some issues within the construction industry.
So just as a follow-on on that, how are amenities evolving in the residential offering in terms of, are you introducing common areas for office space for those that can't accommodate within their units? So we'll ask Jamie first and then Ash.
Yeah, well, I think everybody appreciates their balcony a lot more than they used to about 18 months ago. So I think as developers, we need to, we sort of moved in that trend to try to justify in our minds, could we go without the balcony, right? Because it's more efficient, but maybe people are actually going to see value and we actually get paid for the balcony. So that's an interesting one. I'm just not sure if that's just a temporary reaction to us all having a little bit of stir craziness. But to your point, again, everything we talk about today is what we've seen COVID do is accelerate a trend. So before COVID, we talked about the need for lots of common space and smaller units within apartments and condos. People wanted to socialize, even if they had a computer in front of them, they still wanted to be in a room with other people. So the next step evolution for that is, even though people want to work from home, if you actually look at the trend with remote workers, a lot of them don't actually physically work in their home. They just want to work not in the office. So whether it's Starbucks, et cetera. So that's where these common spaces are going to be very popular. That if you mix it with some of the health needs of what we just experienced, so spacing, plexiglass, whatever that might look like, there's going to be a real attraction to individuals that have smaller units, still don't want to go into the office, but want to have an interesting program space to work from. And then the other piece is there's this concept of the Zoom room, or the need to have office space within the apartments. The apartments aren't going to get bigger. So the way that we're looking at it is, how can we help program the space for the prospective tenants? So pre-planning the furniture as part of the suite design, and then being able to kind of sell that as part of the attraction of the unit, and to show how the office can integrate into the space.
Interesting. Ash?
Yeah, so I'll be honest and frank here. I think we all start with our designs of our multifamily buildings with loads of amenities, and the economics very quickly take hold. And you need an efficient building to get the numbers to work. I think on the other front, leasing up a building in Canada is a very different exercise than leasing up a building in the US, right? The amenity programs in the US are largely driven by the competition factor. The dynamic in Canada is such that you'll lease up that building. It becomes more of a question of what Jamie said is, will people pay if you have more amenities? And I think that's still an outstanding question in Canada that really hasn't been tested that well. I think it's been tested in the luxury market. And I think for sure you see some of that occurring. But when you get to the sort of more, I'll call it mid-market purpose-built rentals, it's unclear whether people will pay more than the rents that we're asking to justify the new build for more amenity space, which reduces the efficiency of the building. So I think what you're seeing, or what we're trying to do, is keep the amenity space the same, but allow it to flex, not too dissimilar to the office that I was talking about earlier. Allow it to flex to accommodate some of these things that may or may not be temporary, the Zoom room, a small flexible office space for people that want to get out of their 500 square foot apartment, but not necessarily be locked into tens of thousands of square feet of common area that is not rent producing.
Yeah, super interesting to wait and see what happens with these introductions, these ideas, and how the market will respond to them. And so we've talked about affordable, we've touched upon housing affordability as an issue from a supply perspective. Most of the focus has been on supply, but then government regulations are also changing, and many interviewees mentioned the challenges with government regulation, CMHC rules, and as being a constraint, as well as inclusionary zoning requirements. Give us your thoughts on, again, with regards to these regulations and inclusionary zoning, the opportunities that there is for improvement or additional constraints in the market to potentially solve this problem if it can be solved. And I'll ask Andrew to answer that first, and then Colin.
Thanks, Miriam. I think we've touched on it a bit. I think actually, I think Frank in his summary up front did a really good job of explaining how the affordability crisis relies on three things. It's almost like a three-legged stool, being supply, governmental relations, and labor. I think there's been a lot of talk about government relations recently, especially in terms of Toronto doing a framework of what their inclusionary zoning looks like. I think the overall comment I'd have on the regulation side is I think there needs to be further work from all three levels of government on alignment. The federal government through CMHC is focused on financing, but for example, we still pay HST on rental buildings and we don't know what it is until the end of the project. And it's extremely variable. And it's pretty much a negotiation, to be honest, with CRA. And any developer will tell you if you have a pro forma where there's a number that's variable to the end, that's really not a good risk mitigation strategy. So that's a problem that has to be fixed. The province, I think in Ontario, has done a good job of focusing on trying to increase supply through changing zoning regulations. But municipalities, and Toronto's at the forefront of it now, have been focused on requiring a percentage of affordable housing in new buildings, but haven't really figured out how to provide incentives to do it. And any inclusionary zoning policy across North America where that has had any shadow of working or any impression of working, where it has incentives behind it, and all the affordable housing being built in Toronto right now, whether through open door or otherwise, has incentives. The policy they're pouring right now does not. The one thing I'd say they have gotten right so far is, if they want to encourage purpose-built rental housing, they're not requiring a set-aside rate for purpose-built rental housing now. And then finally, the supply issue, or the labor issue. If the market can only build just under 30,000 units a year, unless we fix that, we're not going to be able to solve the affordability crisis, especially in the city of Toronto.
Colin?
Sure. So RioCan, Fangate, and Brookfield, those would be three very socially responsible organizations with very socially responsible leadership teams. But at the end of the day, they have obligations to their shareholders and unit holders, so they have to make a return. And I guess I'd go back to what Ash has mentioned. It is getting a lot harder to make pro formas work. Land costs are rising. We've talked about labor costs. We've talked about shortages. One thing this pandemic's done is really apprenticeship programs were put on hold for 18 months. So I think, getting plumbers and electricians is going to be challenges going forward. So I think anything that can address making pro formas more economically viable for developers, I think is very key. And that's where we get to these all three levels of government helping there, whether it is zoning approval being quicker, the whole question about multiple suites, et cetera. And so there's no easy answer to this, but definitely all three levels of government have to play a role in conjunction with the development community. I will say that, if you're looking at things that can help with supply, so CMHC's, their rapid housing, $1 billion program is aimed at creating new affordable housing units. It covers construction of modular housing, land acquisition, and importantly, conversion of existing buildings. I just did a market overview for the Ottawa Real Estate Forum, and we found 4 downtown buildings that had been converted to multi-res. 3 of them are hotels, and we all know some of the challenges of the hotel sector. And one was an older sort of C-class office building, which I talked about will be challenged anyway. So I think if we can look to some conversion of those types of properties, that could help in alleviating a bit of the affordable housing crisis.
Miriam,
Miriam, you're on mute.
Sorry, can you hear me?
Yep.
I have that lawnmower that starts at the beginning of every discussion that I have these days. So it's just a function of our beautiful virtual world right now. But just in terms of, we saw that the second ranking best bet is single family homes. So if you could just talk a little bit about I'm really being distracted right now, so sorry everybody on that one. But if you could just talk to us about what your thinking is around, the viability of the single family home rental. If we could start with Jamie and then go to Ash on that.
Thanks, Miriam. I had garbage trucks outside, so I can emphasize all that noise. So just it's actually quite funny if you look at this topic. So Europe has been doing single family home rentals for probably 100 years. US has been doing it for, decades, and it's been very popular. They're very sticky tenants. They're a nice tenant profile. If you look at the trends in the US, rental growth is double in these communities versus what they are in their standard high-rise rentals. So all really great dynamics. Canada, we haven't gone in that direction, and that's, I think, a social issue. And if you actually read, say, Forbes that talks about it in the US, it's all very positive and focused on the positive investment dynamics. If you read the CBC in Canada with what CORE announced, or I think it was earlier this year, it was like, there were like pitchforks coming for them. So I think although economically you can make sense of it, everybody's first reaction is no, land costs, etc. Well, that's maybe if you're looking at it in a tight GTA context. If you expand your lens to secondary markets and across Canada, the economics can work, especially with the positive results that we're seeing out of the US. But we need to solve the social issue. There's going to be a perception that if developers start buying up swaths of land and building houses and turning them into rentals, that we're taking away from those first-time home buyers. So as much as we might be enabling people to create maybe a transitionary home from their downtown apartment into a home and then ultimately own, those are all positive things. We need to work with groups like CMHC and understand how do we not negatively affect those first-time home buyers and deal with the perception in society in Canada in order to capitalize on the positive economics of this product.
Colin, why don't you go?
Sure, Miriam. I guess, there's 15 million single family, rental units, 15 million in the US. And a lot of them are in warmer climates. They are suburban locations. And I just feel that my concern is about the critical mass and whether we can get scalability in Canada, quite frankly. And yes, land cost is an issue, but I think just, our climate and how our urbanization here, I can see perhaps, the Oshawas, the Hamiltons, the Kitchener-Waterloos, those suburban, being able, some viability there. But if you're going to start a fund, then by the way, I am talking to a couple of people who are interested in this. It's getting the scalability, because you need economies of scale to make it work, to make it financially viable. And that's my concern, is that I just don't know if we can do it. Certainly not to the scale in the US, maybe in select communities and select suburban areas. But that's my feeling.
Right. And Andrew?
I think it's an asset class that, given where our development pipeline is, we're not focused on. A lot of our grocery anchored retail centers we're looking at redeveloping are much better for high rise.
Right.
I think it's an interesting play. I think some of the things that have generated this market in the last 20 years in the States was the subprime mortgage crisis, and a situation where there was a ton of product in the market. Someone could buy in and buy whole neighborhoods, and as Colin said, leverage the economy of scale in terms of property management. I'm fascinated to see what happens with it. I think I'm supportive of anything that goes further to solve the affordability crisis and increase supply.
Yeah. It'll be interesting to see what happens with this sector in the next couple of years, because it really has become entrenched in the US. So we'll see whether there's a business case for it in Canada. But turning to another very hot topic this year, and it was part of Frank's presentation again, was ESG. So this has been an area of continued focus over the past few years. It's really not a new topic. It's just, again, accelerated. Pension funds and large corps have been leading the pack on initiatives on this. And there's been a pretty wide adoption on the E side of the ESG, the environmental component, but more of a conversation this year going forward on the other elements, the social and governance components of it. So talk about some of the ESG elements your firm will be incorporating in the next 12 to 24 months, and what do you see as some of the obstacles to organizations embracing ESG? And we'll start with Ash on this, and then Andrew and Jamie.
Thanks, Miriam. So we've been working on our ESG platform for a while now, well pre-COVID. So it's pretty well established. We've been doing sort of our sustainability reports annually for a number of years now, which gives us some good insight into some of the obstacles or pressure points that we see. And I'd say the main one, quite frankly, is standardization of measurements and how you actually report your success or lack of success on some of your objectives. And for us as a investor, like client-focused organization, what we are always concerned about is, are we being compared correctly from our investors' perspective across all of their other managers? And so it does, like the standardization and the development of metrics that actually make sense and that everyone is using. You almost need like the GAAP or IFRS of sustainability on at least on the environmental front to measure some of these things. I'd say the other big obstacle we're having is, and it's not a new realization, but the reality that at least now, while you're, and specific to some of the sustainability and net zero aspects, there is a cost to these, and it will be reflected in your returns. Over time, as it becomes more prevalent and more standardized, or everyone is doing the same thing or trying to achieve the same thing, I think you'll see that level out. But if you're going to be a first mover or a sort of a starter in some of these things and decide I'm going to build the first net zero office building in Toronto, there's a cost to that. And you have to be willing and aware to take that cost for that initiative, which I think you're going to start to see more people willing to do. Again, it's just the level of importance these days, not just for investors, but for society as a whole.
Andrew?
I agree with a lot of Ash's comments. I'd say when we think about what the obstacles to an organization committing to this, it's just that commitment. It's not a glossy sustainability report, although everyone issues those, and those are important with fancy pictures. It's the commitment and the organization. And I'd say us as an example, we've been hard at work at this for a number of years, and it has to be knitted through the entire organization, from our board's commitment to it, from our senior executives, through everything we do. It's on our scorecards now. It affects our compensation. It's aligned with what we do in terms of when we're looking at our returns, when we're investing in certain asset classes. It is, and I think, when we started this kind of journey on this, which we kind of embarked on in 2016, the question was, this is table stakes from an investor standpoint, and it may not save us, but cost us money at this point. But we're seeing that in some aspects of where we're committed to ESG, for example, green bond frameworks, we are starting to see savings, and we are starting to see return as investments. It's not broad, but again, you've got to have the stomach to commit to it. It's got to be something that's embedded in your organization. You've got to have a dedicated, my view, you've got to have a dedicated ESG team or sustainability team. And now that's grown into also having a DEI council. And it's more than just the E. It started with the E and us, to Ash's point, measuring everything. And for a REIT that has a number of different asset classes, even in retail, it's tough to measure stuff. We spent money on measurement. We spent a lot of time and effort on measurement. But now it's the commitment to that and the S and the G. And especially in a pandemic world, being committed to the S part in terms of your people, in terms of understanding employee engagement, tenant engagement, giving people all the mental health support they need. So it's an ethos, and I think we're proud of the fact that we believe we've knitted it into who we are from a culture standpoint.
Jamie?
Same kind of concept. I mean, from an E perspective, the biggest challenge we have is actually legacy assets. It's really easy to integrate environmental, sustainability into new builds. And there is a business case associated with it. It's actually getting to some of the older assets and building an economically viable business case to make those investments and actually have an impact, and then follow on the measurements associated with it too. But if you move on to the S, that's an interesting one, and actually probably where we've spent more of our time this year than anything. We actually call it an EBID council, so equity, belonging, inclusion, diversity. And the culture in the company needs to be ready for it, because there are some really uncomfortable conversations that are being had within our firm, and you can't just slough it off. You actually need to action it. And when we meet as an EBID, we call it the think tank, is that people use the term finding a safe space. And that's wonderful that we've been able to create a safe space, but it's actually scary that there wasn't a feeling of a safe space before, and what were the drivers in our culture that may have caused that, and are we fixing them fast enough? And then from our standpoint, we have the privilege of working on behalf of a client that we're trying to keep up with their social side of things. Like, they're very focused on human rights, workers' rights. They're on Twitter, they're on LinkedIn, and they're always addressing whatever the issue is that they feel passionate about, because it permeates through their workforce, very diverse workforce. So it's exciting. I love it. I love to see the change, but it is a major commitment, and it's a major mind shift for everybody.
Thanks for that, Jamie. Just cognizant of time, I'm just going to skip over some of the topics we discussed pre this conversation. But one that I think everyone would like to hear about is that, ESG is a huge investment. It's very costly. And what would you say to a private company looking for a business case on how these investments will yield returns from a valuation perspective? And I'll have Colin respond to that one.
Miriam, great question. And I think, what Ash was talking about, the lack of standardization of measurements, KPIs and metrics is an issue. Like, how do you the initiatives you take in the ESG, how does it translate into capital value? So I'd say for a private company, or even a public company, I can tell you some of the tangible benefits. It is easy for me to think about a platinum LEED certified office building with strong walkability scores, et cetera. I can see that it can generate a higher net rent. I can see that it has a shorter lease up horizon, and therefore I can see that translating into value. Okay, and so that's something that's easy to do. I cannot at this point tell you necessarily that building is getting a quarter point better cap rate, but I can tell you it's driving better income. And again, if you have savings in energy and other things, there's of your gross rent, more is net rent because you're saving an operating cost. So I think that is where a lot of the focus has been on the E part. And I think that is, from a valuer perspective, that is where I can see the really tangible benefits translating into value in that regard. And again, Andrew talked about green bonds. That's something that we can see as tangible. And I would just say that I think Frank mentioned it in his opening, that Europe is far ahead of us in this, and then I'd say the US would be next, and then we're lagging a little bit, but more to come on this. But right now, a lot of the focus is still being on the E from a valuation perspective.
Okay, thanks, Colin, for that. And our last topic, war for talent. That's something that it's top of mind for everybody. So because we're coming to a quick close on this, can each of you give me 3 words that describe your thoughts on this topic? And we'll start with Andrew, and then go to Ash, Jamie, and Colin.
Thanks. I'll try to be brief, and because I know we're tight for time, but I think the Great Resignation is upon us. We're seeing it across the entire industry. I would say it goes back to some of the stuff we talked about in ESG. You got to be focused on people. You got to be focused on understanding what your people need to perform, whether it's being more flexible in the workplace, whether it's ensuring they've got the support they need in the workplace, and then also being firmly focused on differentiating yourself from a culture standpoint when they are in the office. I think to Ash's point earlier, I think we're very, very focused on all those things to make sure that we're a place that people want to choose to work above all others. So those are my comments.
I think I'm next. I'm going to use some hyphenated words and cheat a bit here, but I'm going to say that this is non-transitory. I think these changes are embedded, and I think as an employer, you can't really wait them out. I'm going to piggyback on a lot of what Jamie said, and I think Andrew referred to culture. Your culture will win out over time. It may not today, because people may be more focused today on I want 4 days a week at home versus culture instead of 2 days a week. But over time, it will win out, especially for some of the S and ESG. If you're focused on that, employees are way more focused on that and who they work for these days. I think that was only two, but in the interest of time, I'll leave the third.
It was more than 3 words, though. It was more than
very much. A lot of hyphens.
Jamie?
I'd say my 3 words are transparency into compensation. There's a big push for that. Flexibility in how you're working. And then the third thing is mental health support.
Yeah. Colin?
All right, Jamie took one of my words. I had flexibility, which we've talked about a lot, but I'll go with connectivity, which is directly related to culture. And the last one is creativity. We're all going to have to be creative on how we, compete and win this war for talent and get the culture back into organizations. Those are my 3.
Thanks, Colin. This has been an incredibly insightful conversation. Hopefully everyone listening has been able to gain some additional insight into what we can expect in the next year or so. And thanks to all the panelists for taking the time to join us today and for sharing your insights. Now I'd like to hand it over to Les Klein, Principal at BDP Quadrangle. Over to you.
Thank you to our moderator, Miriam, and to our panelists, Ashley, Jamie, Colin, and Andrew. I have no idea why my video is not working, but I'm going to try. As always, we've been treated to many fascinating insights on our industry's ever-evolving landscape. These insights and Frank's earlier analysis have helped us to put our own individual and anecdotal experiences over the past year into a larger context. I especially loved Ash's allusion to the roaring 20s. So I guess the message is fasten your seatbelts. Thank you all for such a dynamic and thought-provoking dialogue. It's my pleasure to introduce our speakers for the closing conversation today. Leslie Wu, Chief Executive Officer at Civic Action, and Michael Cooper, President and Chief Responsible Officer of DREAM and the founder of DREAM Asset Management. Leslie Wu is a respected leader with over 25 years of experience building sustainable communities and shaping urban development in Canada's fastest growing urban region, Greater Toronto. Prior to assuming her role of CEO at Civic Action in September 2020, she was Metrolinx's Chief Planning and Development Officer. You can find Leslie's bio in the chat. And Michael Cooper is the President and Chief Responsible Officer of DREAM and founder of DREAM Asset Management. He's also the Chair and Chief Executive Officer of DREAM Office REIT. He has extensive track record in the real estate industry dating back to 1986. And he helped found DREAM Asset Management in 1996 and continues to lead the business. Michael's bio has also been placed in the chat. At this point, I'll turn it over to you, Leslie.
Excellent, thank you. And good morning, everyone. Welcome, welcome. It's a delight to be here at the ULI stage. So we've had the opportunity, Frank, to lead us off talking about the murky future that we have ahead of us. And as a planner, I know the moment we make a prediction of a forecast, it's probably all wrong anyways. And But I think what is clear that there's an opportunity ahead for the industry, not only to think about its success, but the success of the city, region, and the country in general. And a key to that is a recovery that is inclusive. And at Civic Action, we're working to build better, more inclusive cities. And I've seen firsthand, there's nothing more important to our communities than those who lead them. Michael Cooper is that kind of innovative, curious leader that we probably all need now to challenge the status quo and to build cities where everyone feels like they belong. It's Michael's creative thinking that has always kept him one step ahead of everyone. And it's his risk-taking spirit that now has him stand as one of the industry's most impactful investors and developers. I've met Michael and understand that his passion for his work extends beyond the bottom line, and seen personally how his commitment through my work at the YMCA, GTA, and the work he's done there. So Michael, welcome.
Thank you.
So we're going to get going. First of all, Michael, you've said previously to me that there are no more formulas for success. You've taken the concept of fail fast and driven it into the culture of dream and a culture of innovation. So question number one, do you consider yourself a rebel? And is challenging the status quo now more than ever what is key to business success?
Great questions. The first one is probably do consider myself a rebel. And the second one is a bit more complicated because, you know, contrarians are people who do things that the consensus doesn't do. And I think what's a false alternative there is sometimes you should do what everybody else is doing and sometimes you should not. And sometimes you should do what everybody's doing just a little bit differently. So I think that your comment about skeptical is really, really interesting because trying to figure out what's working and what's not working is really important. So this morning we're talking about emerging trends. It's a great idea. And with emerging trends, sometimes they become full-blown ideas, other times they peter out. And I think we're just sitting in a moment of time with just a tremendous amount of ideas, a tremendous amount of innovation, a tremendous amount of challenges. And it's going to be really exciting to figure out how we all position our businesses, our personal lives, the way we live, the way we relate to other people, what we think is fair and how we're personally contributing to fair. So I think there's a lot in the soup right now and figuring out over a while, not in the meantime, but in a while, is really exciting. And I think it's really important.
So as a leader and the leader of Dream, as you think about the culture and the talent that you are nurturing in your organization, any tips or quips? I mean, the panel before talked about culture as an important element of attracting and retaining the talent that is needed in this industry. Talk a little bit about Dream culture.
So we hired people out of school a lot. And we try to really push people to be the best they can. And we give responsibility very early. And we see how it goes. And a lot of times it goes great. And a lot of times it doesn't. But everybody learns. I mean, I had lunch with a former senior leader of our company who no longer works with us. And I do that quite a bit. And one thing I would challenge everybody on is, you know, what's your relationship like with people that you worked with before and have moved on? We have tremendous relationships. We have board members that used to work on our company. And I think it really goes to the respect you have for people. If you respect them when you're with your company, and then as they go on to pursue other ideas, if you respect them then as well. So I think it's just an easy test. If you think everybody's left your company is lesser quality than people who stayed, if you think people who left aren't loyal, if you think those kinds of words, I think you got to look at your culture.
Thanks, Michael. So for this audience and corporate Canada in general, and I think the panel before and Frank talked about this move towards ESG standards to measure investments. Now, my understanding is that ESG's, its primary goal is around the identification of risk and growth opportunities for a corporation. Do you think the industry is on the right track focusing in this space, or is there a better path that has a greater impact in terms of equitable sharing with communities beyond just the development industry?
Well, I think there's a broader community that this fits into. ESG traditionally is looking at the risk to an organization, to their future ability to produce profits based on how they deal with environmental, social, and governance risks. So it's really a negative point of view. We've got ESG ETFs. They look a lot like the S&P 500 ETFs. We have an SEC investigation into Deutsche Bank, who was selling an ETF, an ESG product, but they didn't actually do any. BlackRock has had whistleblowers saying that they don't do the ESG they talk about. There's definitely movements from the largest investors into standardizing measurements. The accounting organizations are looking at how do they standardize measurements and how do they include them in accounting. So we're at the early stages, but I do think that we've got to be skeptical about ESG because everybody's talking about it, investors want it, and look a little deeper to figure out how do we manage businesses responsibly. We focused on impact, which is the complete opposite of ESG. It's how do you measure positive additions to our communities through what we're doing. And I like it better because it's not just looking at the negative risk, it's how many affordable housing units are you creating? How much rent are you saving people? How many metric tons of carbon are you getting out of the atmosphere? And we're doing a lot on the social front. So we are at the early part of it. I think it's great that people are committed to it. I would say that our company believes that it's a moneymaker. The way that we deal with impact and just generally being a real responsible company, if we work well with others and if we're really quick to identify ideas, we think we'll make a lot of money while we're doing a lot of good. And going back to, I think Ash made the point that we need a lot more homes in order to make a dent on things. I think the key thing about impact investing or socially responsible investing is you got to get scale. And there's just hardly anybody in the world that's happy to invest at a below market return. So the real goal to get scale is how do you achieve the social goals while you're getting a fair return? So, our view is we don't sacrifice returns to do good work. We push ourselves to be really innovative in private and with public-private partnerships to create assets that are outstanding and very profitable.
So Michael, I mean, this is an interesting topic. I spend a lot of time with young leaders across the region, and if they were in this room when Frank was making his presentation, it would be a tale of two cities. The success of the industry is experiencing and what others are experiencing in certain parts of this region, they're quite diametrically opposed. And so part of what I'd love to kind of dig a little deeper on this notion of impact is how and is it that what are the systemic barriers to allowing every dollar that's invested, every dollar of value that's generated has the ability to reach those who aren't really sharing in the full benefits without sort of, I think the panel earlier talked about the ability to still, this is the capital market, still make money, but to be able to understand what are the mechanisms, the processes, that, what stands in our way from having a different kind of balance sheet?
Well, I think when you say a different kind of balance sheet, the reference is to one where we have a real accountability and measurement about social good. We'll stick with the kind of balance sheet we have and we'll add that one. We're not going to change our balance sheet. But just a couple of comments, because this morning's really been focused about real estate. A lot has been Canadian real estate. But while the session's been going on, Goldman Sachs came out with their earnings for one quarter at $5 billion. And they have a $130 billion market cap. That's about a 16% annualized return on their stock price. Another thing that happened in the last 12 months is more money's been invested in the stock market than in the last 25 years combined. There's a tremendous amount of capital available. A lot of that capital is under the oversight of asset managers, sovereign wealth funds, and pension funds who have made significant commitments that their capital will be used responsibly to better the returns of the people who have the financial right to that money, as well as the social benefits of the people that you were speaking about. So there's a very large audience that's looking to invest in ideas that will really address a lot of the social wrongs, a lot of the unfairness in society right now. The government has made a lot of statements and they have a lot of money. It is a tricky business dealing with 3 layers of government. And in each of those layers, there's 20 or 30 different departments that you might have to deal with, plus a lot of different politicians. So it's difficult. But I think that the goal is to deal with real estate a lot more like with infrastructure, where you reduce the overall cost of capital. And you can do that with things like RCFI financing. A lot of the financial institutions have made huge commitments on wanting to finance affordable housing. And if you can get higher leverage, lesser recourse, and lower interest, you can get a return on your equity that's very competitive while you're delivering real benefits. So from our view, we think for every $100 million of equity we invest in impact, we can reduce an equal amount of environmental greenhouse emissions to about 3.5 million kilometers of driving. We think we can create about 750 affordable houses. On just $100 million of equity, we think we can reduce the rent to the people who are living in that 30 to 40% of the building by $2.7 million a year. $100 million of equity can get us $2.7 million a year savings to our tenants. We think we can get a 14 to 16% return on the development and hold of those kinds of assets. In addition, the area that we focus on that is the most exciting, it's the least measurable, and it's by far the hardest, is how do we make our communities more inclusive? So we're announcing next month a procurement strategy we have where we're going to try to work with underrepresented groups who own businesses, working very closely with them, identifying them, and providing ability to close the gaps with them. We're going to try to really step up and see if we can help good small businesses become bigger businesses by being their customer. So we think that's going to provide tremendous amount of minority jobs and hours of work. We're also really focused philanthropically. This is the only area we have not been able to solve yet with a good return, is the programming of our communities with tutoring and education and kids care. And so we're going to do that in a philanthropic way. But we think we're going to get rewarded by decent returns on what we're doing. We're going to get rewarded by being able to attract more capital. I think you will see lower cap rates for assets that people want to own that fulfill their mandate, things that they become signatories of. And we're seeing that already, where we can get higher debt and a lower interest rate on really impactful projects. And that really helps our return on equity. And, again, it's balancing all of the different goals that you have. But I think if we're really creative and innovative and work well with others, we're going to be able to find a lot of opportunities to make it profitable, to provide the benefits that literally only real estate can provide to make our society fairer.
Amazing. And so, Michael, you sort of created the great segue for my next investigation. You talked about levels of government having to cooperate. Civic action, we believe that not consensus, but that bringing different industries, different levels of government together is one of the ways to find solutions. However, in these uncertain times, what is the role of government? Is it just to step out of the way and allow creativity and innovation to take place, or is it really, as what happened in the pandemic, government actually had to come and clamp down more? Your thoughts about this?
I'm apolitical. Like I look at it with confusion as to how it functions. But I think that a lot of the things we're trying to do cannot be accomplished without the government's involvement. And I think the government plays a role in real estate that it doesn't play in many industries. Like, it plays a much bigger role in real estate than it does in anything the CRTC does, or even any regulated business, because we have to talk about every single thing we do. You can't put up a garage in your backyard without asking the government. And I don't complain about it. I'm just saying, to think about our business without the government's complete involvement is illusory. The government's actually got a lot done over the last few years as well, and I think that's very encouraging. I don't want to say how the government should work. I would just say that our experience is that working really hard with the government, listening very hard, we view our role to achieve the financial and social goals that we're seeking is to help the government achieve their stated goals. So we spend a lot of time trying to really understand what it is that they want and how to work that into what we believe in as well. So I think that they are on our side as opposed to being an opposite side. It's just really hard to figure out how to execute with them. Having said that, in the last 3 years, we have been more involved with helping the government create policy than I've ever been in my life. And they've been very thoughtful. And I think all of us have the ability to change government policies if we work with them openly and thoughtfully and respectfully.
Thank you. So I'm going to shift to a topic that is probably an unusual topic for this audience to delve into, but it is about land. And so we've seen during the pandemic, I talked a little earlier about people experiencing the pandemic differently, but in particular, Indigenous communities. And in the last year, quite a lot more has been revealed around the tragedies that those communities have experienced. And in this Greater Toronto Hamilton area in particular, we've got the largest urban Indigenous community and growing at quite a rate, like the percentage of growth is quite significant. And many organizations have been doing cultural competencies on indigeneity and so on and so forth. And a critique emerging around how much of this is performative. So my question goes like this. So land is a fundamental aspect of Indigenous culture. And we are in the land development industry. And this industry has benefited quite significantly from the value extraction of land, but we're all treaty people, and so it's a privilege to be in this industry in many respects. Do you think, so this is a big question, do you think that this industry and its leadership can be part of what the Truth and Reconciliation Committee calls economic reconciliation?
I mean, it's a big question, much bigger than anything I could respond to. I would say that finding all those graves from residential schools was absolutely shocking. And I would say further that it's another indication of how little I know about what it means to be Indigenous in Canada. And I'm more comfortable thinking about it like I have no idea what it's like to be Indigenous in Canada than thinking that I understand it. We do a lot of work with Indigenous, and we're building, I think, the only Indigenous hub in a city center in downtown Toronto with a couple of partners. And ironically, we'll have no affordable housing because we had to work so hard to get density to come up with the money to help them fund their traditional and Western medicine, their career center, their business incubator, and daycare, so people can go there. That we had to do everything at market. We had to work really hard with the city to get the density. It's going to be an amazing, amazing project. And I think what we're doing is really helpful for them. And I think they've been very helpful for us. We've got a net zero community in Ottawa that we've done a lot of work with the Algonquin, and we're mentoring people, we're hiring people. There's going to be 3 languages because it's both in Ontario and Quebec. It's going to be Algonquin, English, and French. We've worked with them to try to create a development that gives them access to their traditional lands. And that's literally access to the river that had been closed off for 200 years. So we try to do a lot of work with the First Nations, and we try to help them. I think real estate can have a lot of influence on the First Nations' ability to make money. I think from our perspective, if we are good at dealing with the First Nations and we're honorable about it, it's going to have tremendous benefits for our organization. So the bigger questions that you asked me, I'm not going there, but I would say that we're finding ways that we feel as if we're treating First Nations responsibly, and we're helping them be partners, and we're listening to them, and we're doing great real estate with them.
I appreciate that, Michael, because I think everybody is on this journey. There's no answer to this question, but if it's an important one for everyone to be thinking about, and clearly in the work you're doing, you're making those steps in that direction. This will probably be our final question, and unless you have some questions for me. So Michael, there's been quite a wide range of conversation, both specifically around the details within which the PwC report sets forward. We've talked about ESGs and the breadth of topics that includes. There was earlier, Jamie raised the whole issue of within culture around issues of mental health. We talked about affordability. And it's clear that the industry is at a very important space and point. And as you look out at there's I think 300 and over 300, close to 400 people now listening in, and more will because the event is being recorded. Is there a call to action to this industry right now that is distinct from anything that we might have thought of 2 years ago? Given what we've gone through, the industry is doing well, according to Frank. Should we be satisfied that we are all, is there anything more that the industry could be doing?
Well, I mean, there's a couple of things. Jamie mentioned about safe space at work, and I think that's an area that we should all focus on more. One area that we think is really important is to provide a sense of purpose through our work. And I think it makes people want to do a better job, want to be part of our group. You mentioned privilege, and I think that as a real estate industry, we are only allowed to do what others let us do. We actually have virtually no rights without government and the community on our side. So, the fact that there's been about $450 billion spent to sort of float all businesses, or almost all businesses, we've been very lucky. And I think our industry should really focus on how we make sure that the privilege that we have is justified. And if you look at Berlin, they just had a referendum to privatize, to nationalize a bunch of apartments. So the outcomes ahead of us are really unknown. If we behave well, I think there's a really good chance we'll do amazing things to benefit all of society. And if we don't, I think that we may end up facing communities that don't like us and governments that don't support us. So, I think we're doing amazing work, and I'm really proud of it. I think we've got great purpose. But if anybody thinks for a minute anything we're doing isn't out of self-interest and self-preservation, I think they don't understand what we're doing. And I'd also suggest that we all need to work together to make sure that every day, every time we build a building, the people that walk by it, the people that live, like everybody has to be better off, or we're not going to continue to have that privilege in the same way we've had it in the past.
Terrific. So Michael, those were my questions. This has been an amazing conversation. Thank you for your openness and honesty in your answers, and allowing me the time to spend with you, and to the ULI folks as well. At this point, I'm going to hand it over to Jennifer. Are you there, Jennifer?
Thank you.
You're very welcome.
Thank you so much, Leslie and Michael, for that engaging conversation. I actually don't know where the time has gone. This morning has just absolutely flown by. My name is Jennifer Kahn, and I am the Head of Inclusive Diversity at Elliston, and I'm also ULI Toronto's Diversity, Equity, and Inclusion Committee Chair. On behalf of the ULI Management Committee, I'd like to thank everyone for spending your morning with us, and a special thank you to PwC, BDP Quadrangle, Northcrest, and Carpenters Union Local 27 for supporting this program, and of course to all of our annual sponsors for your continued involvement and support. And finally, the ULI is excited to host its first in-person event on Thursday, November the 4th, and we hope that you can join us. The ESG, Environmental, Social, and Governance Symposium will be hosted in Regent Park at the Daniels Spectrum. There's an amazing lineup of speakers, as you can see, with 2 keynotes and 3 plenary panels, followed by in-person tours in the afternoon. Details will be posted in the chat, and of course, you can see a snapshot of the speakers on screen right now. To all of you, Happy Friday, and I hope you have a great weekend. And thank you so much for joining us today.